Thank you, Matthew. I'm delighted to have the opportunity to moderate this discussion with three world-class investors who bring distinct perspectives to the topic at hand, but who have two things in common: exceptional success and a willingness to make bold bets. Scott Bessent comes from the macro investing world, which often thrives on volatility and dislocation. He's currently the founder and chief investment officer of Key Square Capital Management and the former chief investment officer of Soros Fund Management. Devin Parekh is a managing director at Insight Venture Partners, where he has led investments for Insight in a broad range of software and internet firms, such as Twitter, Fanatics, and Chegg. And Jeremy Levine is a partner with Bessent Venture Partners, where he's led investments in the likes of Yelp, Pinterest, and Shopify. Thanks to each of you for joining us today. Let's get started. So one characteristic of nearly any crisis is that it is distinct from past crises. Otherwise, there would be a set playbook. How do you view this crisis as different or similar to past crises? Let's start with you, Scott.
So a lot of my models and a lot of our investments are based on analogs. And I will tell you that I've been doing this now for 35 years. And I've also taught university classes on the history of economic crises. And this is unlike anything that I've seen before. I detest when people use the word unprecedented, but I'm going to use it. And when I try to model what is this like, is it like a war? No, because there's no capacity being destructed. Is it like a natural disaster? Is it like a pandemic that we've seen before? So I think that this is something that's very distinct unto itself. And the roadmap is very difficult.
Devin, what about your perspective here?
Well, I agree with everything Scott just said. I just add that I think the biggest difference from the past is the rapidity with which we had to turn the economy off. And I think that, to me, was the thing that was a little bit hard for most people to process, both as it related to their daily life, which literally changed overnight, but also business. How do you actually deal, particularly with certain end markets, demand going away from 100 to 0 overnight, and with an uncertain view as to how long that demand was going to stay that way. I think that continues to be probably one of the biggest challenges today.
Jeremy, your thoughts on this? Any analogs, or is it truly that different?
Honestly, I don't know what's going on. The disconnection between the financial markets and the economy may be unprecedented, as Scott said. It's confusing. I know it'll be clear in a couple of years what's going on today, but it's very hard to have high confidence that you know what's going on today. And so the question becomes then, what strategy do you pursue as an investor when you're investing in this enormous amount of uncertainty? And I think maybe that's what we can talk about.
You mentioned about the disconnect between the economy and the financial markets. Scott, you made a comment to me about that being it was a newspaper reference. Maybe you want to elaborate on that?
Sure. So I always do a sanity check. If on March 15th, I had yesterday's newspaper. So if I'd had June 15th's newspaper on March 15th with no asset prices, and I was reading about civil unrest in the U.S., the quickest and fastest increase in unemployment since the Great Depression, the bankruptcies, the government intervention, what would I have thought would have happened to the markets? I would have thought it would have been a disaster. So, it really speaks to, and it sounds like we're going to talk about it more in this session, that, in my mind, from crises like this, the biggest opportunities tend to be more medium term than immediate. Like it's fun to catch a trade, and all these millennials seem to be doing it in their Robinhood accounts. But for most investors, that's not a real strategy.
Yeah. So let's pick up on the opportunities. Love to hear each of you comment on the opportunities and dangers here. Devin, why don't you take that one first?
Yeah, I think we've been actually, while slower than last year, reasonably active. So since COVID in mid-March, we've actually closed 9 new investments. I think the thing that we're looking for, which is, pretty rare, is companies have continued to grow at pretty strong rates through this. And there's really only one way to do that, is if you've got some tailwind from some market that's in effect benefiting from what's happening right now. And just to take it at a high level, and we talked about one earlier, Alec, with TytoCare, which is a company I know you know. But that's if you think about the fact that everybody all of a sudden couldn't go to the hospital or the doctor for any reason other than COVID. There's actually lots of knock-on effects of that. People have high blood pressure, people have high cholesterol, people have a lot of other kind of diabetes, not getting their checkups. And so if you could actually effectively come up with a technology platform where you could do a lot of that from home and have that diagnostic data in the hands of a doctor who can then actually have a telemedicine visit, which is high utility because they actually have data. It's not just a conversation. That actually COVID was a tailwind for that. And so that's one example. We've got plenty of other examples. So I think there are obviously companies that are benefiting. And I make one other macro point. If you look at a lot of companies, if you take retail for an example, someone like Walmart got probably 5 years of e-commerce expertise in 2 months. And they probably are going to stuff 2 to 3 years of CapEx into 2 quarters. And be okay with it. The markets are going to be okay with it. Just like Amazon was able to spend $4 billion for COVID preparedness, and the market ignored it because they viewed it as long-term tailwinds. And so I think you're going to have incumbents, not just the technology incumbents like Amazon, but traditionally offline incumbents like Walmart that are actually going to be able to leverage technology to compete kind of more aggressively. Take one other category, restaurants. And obviously we have some investments that focus on the restaurant industry, and they've had, as you'd expect, a pretty dramatic impact. But if you think about the large quick service chains that are well capitalized and are aggressively using technology to increase delivery, kind of re-engineering their supply chain, they're probably likely going to pick up market share over the next 18 months. And if you're an independent restaurant, you're going to lose market share. So I think there will be, to Scott's point, medium-term beneficiaries. And I think we're all fortunate to be investing in technology, which is, I think, going to be a driving force of catalyzing some of those improvements.
You know, Satya Nadella on his April 30th earnings call said we'd had 2 years of digital transformation in 2 months. So here we are in mid-late June. So I guess that means we've had about 3.5 years in the time period. Jeremy, opportunities, dangers that you see?
You know, in previous crises, there was a massively negative dislocation on valuations. And so in the immediate aftermath of the crisis, it was very hard to get anything done in the private markets because anyone who didn't need to sell equity simply refused to do so. And we found out that actually some of our best investments were made about 18 months to 2 years after the crisis, when pricing started to resettle and suddenly things could happen. And what's been interesting and frustrating about this crisis is that as the crisis has worsened, asset prices have gone up. And so last time around, it was the entrepreneurs who were saying, wait a minute, I don't want to sell my stock cheap. This time around, it's us saying, wait a minute, we don't want to buy your stock super expensive. And so although the trends are exactly opposite from how it worked in the 08-09 financial crisis, I suspect the pattern may end up being somewhat similar, which is that a lot of the best investments happen in sort of the 18 months or 24 months after things have begun to settle down, because that's when no one has to fight about whether prices are artificially high or low. We've sort of settled at what the new normal is, and now you can go find companies that are embracing or accelerated by some of the latest trends, and that might be really interesting 4, 5, 6, 7-year plays, and pricing is no longer the question of the day.
Well, that's a great lead into another question, this timing. I'm sure our viewers would love to hear a war story from each of you about an investment or bet you made during a previous crisis that was either contrarian, controversial, or just downright audacious, but which turned out well. Maybe Scott, you can start us on that one.
Sure, and this goes back to my narrative about what is, and it's what Jeremy said also, is what does the world look like 2 or 3 years out? I remember very well the Fukushima tragedy in Japan. So earthquake, tsunami, the nuclear meltdown, and a complete tragedy. For the area around Fukushima, the Japanese stock market collapsed. The government fell. But, I think that led to Japan coming out of a 20-year malaise. So Fukushima, easy to remember, 3/11/11, after 20 years of being in a malaise, the Japanese people, 18 months later, snapped out of it. They'd had a new prime minister every 6 months. They've been in deflation, and this fellow named Abe showed up. And someone called me and said, "You got to come to Tokyo and meet him. He wants to take Japan out of deflation." And I think the audaciousness of his programs have only been possible after this tragedy. What I think it was Papa who said, "I've had all I can stand no more." And the Japanese people were just fed up, and it was the lack of leadership. They were looking at this industrial giant who was humbled, and for the past 6 or 8 years, Abenomics and Japan, they've reflated. For several years, the Japanese stock market was the best performing market. Japan as a travel and investment, a private equity, the venue came back on everyone's radar screen. So, but hard to believe when you were watching the Fukushima burn that this could happen 18 months later.
Yeah. Devin, you got a contrarian or controversial bet you made in a crisis you can share with us?
I'm going to answer the question slightly differently, which is just, I think the thing where we've both made money, but also left a lot of money on the table is I think even us who are kind of all we do is software, have probably assumed that there was more cyclicality and less resilience in software than there actually has been, right? So if you kind of look at, I'll use an example of a company we didn't invest in multiple times, Procore, right? And every time we looked at it, we would say, oh, it's a cycle risk, construction, in a recession, it's going to get really negatively impacted. It's now been through, now I don't know what will happen in this cycle, we're not investors, but if you look at the last few cycles, sure, growth slowed down, but it continued to grow. And what we're seeing this time is right after COVID in March, like I'm sure, everybody who had a portfolio, the first thing they did is spend time on their portfolio and figure out what they needed to do from a cost standpoint, as did we. And by and large, we were pretty aggressive on cost. With a couple of exceptions, the actual performance has been way better than we thought. The model has been way more resilient than we thought. I say this as somebody who, this is what all I do and this is all I think about. It's actually been more resilient. And I think that I'm not a hedge fund manager. I'd be a really bad one based on my predictions the last few years. I certainly am not going to start one, but the only hypothesis that I can come up with as to why software multiples are up, on the year, is kind of flight to relative quality, right? So, we've had companies that have, I assumed when they came out and they publicly took guidance down materially, that would have a negative impact on the stock price. That's what normally happens. And actually, we had one of these that stock went up 10, 12% the day they came out with guidance, which was not a small reduction in guidance. And I think the market's reaction clearly was, I thought would have been a lot worse, right? Because that's what's happening to other industries. So I actually think that one of the things that we've underestimated, it's not a direct answer to your question, but like one of the things we've best underestimated is actually how resilient it is. And I think we're seeing that right now. And it's kind of changing the way I think about it a little bit going forward.
Jeremy, you got a quick war story to share with us?
Yeah, I'll share one in a second, but I just want to accentuate Devin's point, because we actually, a bunch of our companies, we similarly said, gosh, it's like flying in an airplane. Now you're in the middle of a cloud. You can't see 2 feet in front of you. And so don't make decisions when you can't see 2 feet in front of you, investment decisions in particular. So conserve your cash, don't spend as much. And they cut a lot of expenses. And then oftentimes they saw in late March, early April, a little bit of a dip in their growth rate, or even a slight shrinkage. But then it came back pretty aggressively, and they realized they didn't need a lot of the expenses that they had cut. And all of a sudden, these businesses that were growing really nicely but burning cash are now growing, maybe not quite as nicely, but making money. And it was like this wonderful surprise. And a few of them have said, hey, this is a more comfortable position to be in. Let's keep it that way. And so it's sort of a don't waste a crisis. certainly rings true there. I'll give you one example of sort of a disaster that happened to me that could have been great if we just held on a little longer. And so maybe about 5 years ago, I did a super early stage investment in a company called Rabbit. And the basic idea was everything consumers do offline, they eventually do online. And if you pick a big enough activity, the online version of that becomes a really large company. And so this one was watching television and movies. And what Rabbit enabled you to do was watch TV and movies in perfect sync with many people over the internet. And it grew, it had a very niche audience, and it didn't quite ever manage to break out. And eventually we shut it down because we couldn't quite find a business model. And I'm just wondering, like, if that had survived long enough to see the benefit of COVID, what it could have been. And unfortunately, we just never quite got there.
Yeah,
Sometimes a little bit of extra patience really helps.
Timing can be everything. So we've got just a minute or so left. So maybe you could sum up, each of you, in 1 or 2 sentences, the most important guidance you would provide to our investor viewers today. Scott, why don't you take that first?
Yeah, I'll start, and I'll say, I think the most important thing is to be patient. That these medium-term trends always take longer than you think. To Jeremy's example. And they will become more obvious, so after the tech wreck in 2000, I don't remember when Amazon did their emergency convert, but Warren Buffett said that was the biggest miss he's ever had.
Yeah,
so
big one.
if you could sit and wait and be patient. Because there really is a lot of noise right now, and it's very difficult to separate signal from noise.
Yeah. Devin, quick lesson.
I would say quick lesson is the same. Like I think if you're willing to take a 5 or 10 year view and not a Robin Hood view, I couldn't have a higher conviction about software. If you ask me my next quarter's view, I have no idea. But that's not how we invest. But I think that this crisis is going to drive even more investment in digital transformation. And so the long-term macro trends are even better than they were before the crisis.
Yeah, and we're seeing that people would rather give up paying their rent than stop paying their software that keeps them connected. Jeremy, your quick guidance for our viewers?
If I had to give one piece of advice, it'd be very similar to what Scott and Devin said, but that would be boring. So I'll give a different one, which would be my second piece of advice. And that is, when you think it's over, it's probably not over yet. And so I think this crisis is so bizarre in so many ways. And I think at least the healthcare version of the crisis, people are now, I think, starting to put into the rearview mirror and saying, oh, we survived it, and getting back out into the world. And I fear that may be a misguided move, and that this one will take a while to play out, both the healthcare version of it and the economic version of it, not to mention the social unrest version of it. And so maybe that's a return to this advice for patience, but don't consider it behind us until it's truly behind us. I
might summarize that one as beware the unknown unknown, as opposed to the known unknown. So
I would say too is you have to have a very open mind, because you just don't know what could happen. I sat and watched 2 airplanes hit the World Trade Center from my terrace. And then 3 years later, Tribeca was the most expensive zip code in Manhattan. Like, who would have ever thought that could have happened? There are going to be things that happen we just can't even imagine.
Right. So patience, open mind. Gentlemen, we're out of time, but want to thank all of you, each of you, for joining us today. It's been truly a privilege, and good luck to you and your firms as you continue to navigate this challenging time. Back to you, Matthew.
Thank you.